So if there is a breach, rather than going after a seller who may not exist or have the means, the buyer actually just claims under a policy. Particularly in secondaries, where it's all about liquidity, we can give synthetic cover for those kind of warranties, and that kind of removes the need for the pension fund sellers to actually go on risk for these items. It's not just the incoming new investors that are going to get the benefit of the policy. Because we're covering the full continuation fund, it's also the original investors that roll over and the GP. And we're actually seeing GPs embed insurance into the process early on, even at bid stage. So it's just a really effective way to manage risk.
Hello, everyone, and thank you for tuning in to another episode of Women of Secondaries, produced by SecondaryLink and hosted by yours truly. By now, if you've been following our episodes, you know my name is Kristina Kulikova. I am the Senior VP of LP Advisory at Setter Capital, and I'm absolutely privileged to host Women of Secondaries, where we cast light on the incredible powerhouse women driving this market. If you missed our prior episodes, I do encourage you to check them out. They are on the SecondaryLink video and podcast section on the website. It's also on YouTube and Spotify, so you can really catch short snippets of the discussion wherever you feel comfortable, and also on the SecondaryLink LinkedIn page. So today's episode is really a big treat, since we haven't talked much about this topic on our show yet. And really, it's an area of the industry that's often viewed as somewhat complicated and doesn't get nearly as much coverage as it should. And that is reps and warranties insurance in secondary deals. Here to dispel the myth about RWI being complicated and discuss the various use cases which actually simplify transactions, lower risk and costs, and essentially ensure the transaction comes together, we have the senior underwriter of the leading provider of transaction liability insurance solutions for the secondary market, the global transaction insurance firm CFC. Sarah Cardiff is here to join us. This powerhouse woman comes with a fascinating and tenured background as a former corporate lawyer at a top Irish law firm, advising on private equity investments and the establishment of investment funds, a knowledge base which she skillfully applies to her work as CFC's lead for underwriting of EMEA secondaries. She works across the US and internationally on a variety of M&A and complex secondary transactions, advising on over 18 billion NAV worth of deals. And Sarah has a wonderful way about her of making the seemingly complex be straightforward, digestible, and palatable. Welcome, Sarah Cardiff. Hi, Sarah.
Hi, Kristina. I don't think I've ever had such a complimentary introduction or reflected on my career like that. So thank you. And thank you for having me. I'm really looking forward to chatting with you.
No, we're so excited. And it's a topic that doesn't get nearly as much coverage. And I think more and more people are starting to ask and inquire. And, as the secondaries market gets potentially more complex in a sense of scale and creativity, I think we're going to really see that expand. And so I guess before we get into the main part of our chat, for those that may have not come across CFC, I'll just give a little bit of a background. CFC is a specialist insurance provider, a pioneer in essentially merging risk, and are recognized as the leading provider of transaction liability insurance solutions for the secondary market. They're headquartered in London with offices across the US, Australia, and Europe. CFC has over 950 employees and is trusted by more than 150,000 businesses in 90 countries. You guys have grown exponentially. This is incredible. CFC provides a range of bespoke solutions to private market investors who are acquiring, divesting, or restructuring interests in private market deals, both across GP-led deals, so think CVs and fund wrap-ups, as well as LP portfolio transfers. So essentially, CFC's solution utilize insurance capital to facilitate transactions and provide an indemnity backstop for breaches of representations, warranties, or the excluded obligations indemnity. But I'll let Sarah, the expert in the room, educate you more on that. I understand that CFC has also recently won the Insurance Insider UK and US awards for Underwriting Innovation of the Year for your secondary offering specifically, which is such a massive accomplishment. But take us back a little bit, maybe. Give us a bit of detailed background on CFC, the various lines of business, including specifically the secondaries insurance arm, how it came about. Love to hear all the juicy details.
Yeah, sure. So CFC actually started as a cyber insurer. So about 20 years ago, they were one of the first companies to offer cyber insurance online. And we're called clickforcover.com. So 20 years on, we're now CFC and offer a range of various insurance across different classes. So cyber, IP, healthcare, and of course, transaction liability, which we're going to speak about today. Transaction liability, or TL, the secondaries team specifically, we are global market leaders, pioneered the product in the US back in 2019 and have continued to provide a range of solutions, as you said, across the private equity space. So for players that are either investing, divesting, or restructuring their interests. We are the largest team in the market, so we have 7 dedicated secondaries underwriters, a mix of backgrounds as corporate lawyers, funds lawyers, tax lawyers, which is really important in understanding the product, but also your client's needs. And the secondaries team is part of the wider TL team. So we're actually a 57-person strong team now and started doing TL more broadly back in 2016. So that includes cover for typical buyouts. We also do contingent and tax insurance for M&A transactions. And I think I joined 3.5 years ago. There was 13 people in the wider TL team. So as you say, just huge growth in the last few years.
And how did you personally end up in secondaries? And specifically, what was your first touch point?
Yeah, so, well, my first touch point with funds was actually as a corporate associate in Ireland. That was back in 2018. And I remember just being intrigued at this way of structuring investments. You know, you don't learn this in law school. And we had some very famous, an Irish Hollywood actor and musician. So that obviously piqued my interest as well. And that is publicized by the sponsors, so not confidential. And then I moved to CFC in 2019 and was just even more intrigued to learn that actually, in certain circumstances, GPs are transferring the assets to themselves. I think secondaries is just an area where there's just continued development. You know, there's new structures, new perspectives. You're always learning. And for us, there's kind of always opportunity for new products and new angles.
Yeah, and so I guess for some audience listening in today who have either never participated in a secondary process, but, you know, are tracking the market closely more and more, or have perhaps participated in many processes, but may not be aware that RWI exists to streamline the process, would you give us a brief explanation of what is reps and warranties insurance as it applies to the secondary market transactions, probably both at the LP and GP level?
Yeah, sure. So in any deal where private equity interests are being sold, the seller is going to give certain representations and warranties that relate to the interest to the buyer in the transaction agreements. They're going to give them contractually. And that's protection for the buyer. If there was a breach of one of those warranties or indemnities, the buyer can contractually claim for compensation against the seller. That assumes that the seller still exists, or if it's an individual, has not gone off into the sunset and, you know, bought a private island. And so what warranty and indemnity insurance does is we actually backstop, or we insure those representations and warranties in the transaction agreement. So if there is a breach, rather than going after a seller who may not exist or have the means, the buyer actually just claims under a policy. And that also takes away the kind of time and cost associated with what often turns into lengthy negotiations and sometimes litigation to try recover costs. So it's just a really effective way to manage risk. Also, in these types of transactions, if the buyer is looking for additional protection, what they may do is hold back some of the purchase price in an indemnity escrow for a year or two. So there is that kind of protection in case the seller didn't have the means if some kind of breach arose. If you use warranty and indemnity insurance in that place, you can free up those funds. So there's no longer a need for that indemnity escrow holdback, particularly in secondaries where it's all about liquidity. Having that insurance in place just means that you can get those distributions or reinvest those funds quicker than if you would if you didn't have the insurance in place. There are other benefits that we see to the reps and warranties. So it can facilitate deal negotiation. So we often see terms where we'll only give this warranty if the insurers cover it. And it doesn't raise questions, but, you know, we're fine with it because sometimes sellers are just more comfortable if they know they have that protection of the reps and warranties policy in place. And that can really streamline negotiations and pull away that kind of protracted back and forth on the minute detail of the warranties. It can also, in a secondary, help with relationship management. Because if you think about it, in a secondary, it's GP-led, the seller's not going away. The sponsor is going to continue to manage the new fund. So if something does go wrong, you can claim against our policy and get the protection there rather than, new investors claiming against their GP. And then RWI insurance on secondaries specifically has the added benefit that in addition to covering the reps and warranties, will also cover the excluded obligations indemnity. And that is usually where the kind of key considerations in a GP-led secondary, such as conflicts of interest or, any unfairness to LPs, can be covered off. So there's protection there for that added excluded obligations element to the deal.
I think it's something that can often delay negotiations. And as you mentioned, going through a claim with an insurance company versus going through the lawsuit and the courts is probably A, faster, B, less costly, both from a time and capital perspective, right? So I think on all fronts, the buyer probably, and the seller, if they get sucked into a lawsuit, or the GP, if they get sucked into a lawsuit, feel better if there's some type of an insurance policy in place, I would imagine. Also, probably from a reputational standpoint, where there is no legal claim on the GP, for example, even if there's issues that arise.
For sure.
So I hope now the audience have a better grasp of what RWI is and some of the covenants it covers. Now let's get to the practical applications. What are some of the use cases of, and you mentioned some of these, but if we dive into a little bit more detail, maybe what are some of the recent transaction examples that your teams worked on where you integrated RWI policy? Would love to hear about.
Yeah, sure. So it's really applicable to all deals. I mean, you don't need necessarily a high risk or a questionable deal to get the benefits of the policy. And, particularly in GP-led, because it's not just the incoming new investors that are going to get the benefit of the policy. Because we're covering the full continuation fund, it's also the original investors that roll over and the GP who's also invested its crystallized carry. And we're actually seeing GPs embed insurance into the process early on, even at bid stage. So they're putting policies into the data room and having the lead investors comment on it as part of the bidding process. But in addition to that, there's various other uses. So say, for example, on LP deals, you may have some more conservative sellers such as pension funds, and they need to be quite careful in terms of the indemnities that they can or can't give. And they may be more conservative in terms of the reps and warranties that they will give. So we can give synthetic cover for those kind of warranties. And that kind of removes the need for the pension fund sellers to actually go on risk for these items. And that is kind of using insurance to bridge the gap. Also, I mean, going back to some of the GP-leds and the point that we made, people are more comfortable when there's insurance in place. If it's a GP's first time doing secondaries, it can help to have that kind of safety net in the background. In terms of some kind of recent or interesting deals, we did a pretty large one towards the end of last year. Actually, it was $3 billion deal. There was not just selling funds, but also selling co-investors, and not just continuation fund buyer, but also co-investor buyers. And sometimes when this comes up, the co-investor will kind of bundle into our policy and we can give them cover within it. But in this particular deal, we actually created a separate policy, which kind of, they tied in together, but it separated out the co-investors cover. And the reason for doing that is theoretically the co-investor may not be impacted by things that we cover in our excluded obligations indemnity. So they're taking direct interest in the target. So they're a little bit less concerned about clawback liabilities from the original fund or claims by the original LPs against the GP for any unfairness. So what we did was actually split out the cover to cater for that co-investor, because if there was a claim under the excluded obligations indemnity, you don't want to wipe out everyone's cover for that, because actually it's not something that necessarily would have wiped out cover for the co-investor.
So you mentioned something that's very important, which is the concept of excluded obligations. But I think if we can get ahead of it and people can really streamline those negotiations, then it may be much more cost effective, much quicker to get through the PSA requirements as well. But can you briefly explain what is the concept of excluded obligations, and maybe what are some of the contentious issues that RWI solves for or simplifies?
Yeah, sure. So I think this is kind of one of the key enhancements that we provide in our cover on secondaries, because it touches on some of those key themes like conflicts of interest and clawback risk. But going back to basics, so the excluded obligations indemnity, when a fund is selling interest, there's certain liabilities that rightly should sit with that selling fund and not be assumed by the continuation fund or the new investors into that fund. So the parties will negotiate the excluded obligations indemnity, and that is essentially indemnifying for any of these selected risks that the buyer feels needs to sit with the original fund. And some of those key indemnity limbs would be clawback liability, or any liabilities that arise from assets that are not part of the transaction. So the selling fund would have had other investments or may have assets remaining in that fund. And as a new investor into the continuation fund, you want to ensure that if anything goes wrong, you're not going to potentially be on the hook for any of those liabilities. Another limb is breach of fiduciary duty, or any claims by the original LP against the GP for breach of fiduciary duties or non-compliance with obligations. So again, as a new investor, you do not want, to suffer a loss because of some of these issues that were, related to the original fund. Other limbs would include seller taxes, ECI or FRICTA withholding obligations that arise again for the seller and should be looked after. So it's really just a good way to ensure that new investors are not going to suffer if there was a successful successor liability claim against the continuation fund for issues that really are more suited to be dealt with by the seller. And so we will cover that excluded obligations indemnity. And it wasn't something that was done originally, but we have kind of, as we got more comfortable with these deals, expanded our cover, saw the value that it brings, and include this routinely. And it doesn't require extra diligence. Again, we will just look at consents, what kind of process is being run with the existing LPs to make sure that there is less likely to be any kind of breach of unfairness, and look at that third-party valuation opinion. So no extra diligence, but, a lot of kind of valuable cover is given through this EO coverage.
And is that just as applicable for LP to LP as well, or would it be mostly for GP deals?
No, the same. So it applies to LPs deals as well. Obviously, you don't have that kind of conflicts issue to the same degree, but again, it will cover clawbacks, any kind of liabilities for contributions not paid up, and again, seller taxes. And that is where you can get that cover for issues such as ECI. So yeah, it's super relevant for LP trades as well.
Thank you for clarifying that. And would you say, because we do get a lot of questions about scale, right? And so does it make sense for a smaller deal? Does it make sense only for larger deals? Could you comment on that briefly?
Yeah, no, it really applies to all of them. And you can scale the coverage to what you need. So what we typically see are parties taking out an insurance limit, which is about 10% of NAV. And so we will scale that up or scale that down as needed. And I don't think there's any GP-led that we've seen that's been too small for us to do. And equally, we haven't seen anything that's too large. So the use case applies to deals of all sizes. And I think on our new LP to LP product, that's something we've been acutely aware of as well, that, there is smaller deals. You're not going to get, well, you will in some cases for big portfolios, but you're not going to get those big figures that you see in your GP-led. So we've tailored the pricing and the process and the cost to reflect that, and to reflect the fact that economics are tighter on LP trades.
You mentioned, as you were going through some of the use cases, you mentioned ECI. And let's talk about that for a second, because that's something that is a thorn in negotiations almost always, regardless of whether there's ECI present or not in the actual transaction, right? But especially if it's cross-jurisdictional, of course, it always comes up. All stakeholders really get involved, and sometimes to try to figure out the ECI issue, and it, can involve costs from like legal hours to tax advisors, both at the GP, at the seller, at the buyer side. And so that is often a very contentious issue. Can you briefly mention why can ECI be a cause for breakdown of transactions? But also, how does RWI assist with solving for those issues, or at least, alleviating?
This is something we're seeing more and more of lately, and it's particularly on the LP secondaries, where you have a European fund and the sale of European interests. And typically it's a US buyer who's coming in and they just want ECI withholding certificates provided as standard. And the European GP, understandably perhaps, just refuses to give it, where they think that the fund either has no exposure to effectively connected income or it's negligible, and they just don't think that it applies and don't want to provide the certificate under penalties of perjury. And so we've had people come to us, and it is, as you said, sometimes it's a deal breaker. It's either protracted negotiations, or it can also result in a price chip. So we have created a new product, so in our LP to LP secondaries, and we will capture ECI risk through either our excluded obligations indemnity, and we'll do that where the risk is low enough that it doesn't really require input from our tax team, or where there is some exposure to ECI. Of course, it has to be within the thresholds before you actually do need to withhold. So less than 10% of the seller's total share of the fund's gross income for the last 3 years, or less than $1 million. So if it's a little bit less than negligible, then we will have our specific tax team who will come in, and we've created a new ECI tax specific product. And whether we do it via the EO or the tax specific product, what we will cover is we'll cover the buyer if they are subject to a tax claim that they should have withheld, or if the fund manager is subject to a tax claim where they need to withhold on distributions to that particular LP where that LP has not withheld. So it's brand new, super interesting. And again, it's just kind of tailoring to that, some of the pain points that we're seeing come up in these deals.
So in that instance, it would be both on the buyer, but then it would also, the GP could also, if they don't want to issue a certificate, they could have this policy in place to provide instead, right?
This is it. It provides that protection, if it's actually also the GP who the tax claim is being made against, for not withholding. So it's protecting all parties, and particularly on the LP deals, the GP isn't going to get super involved here. And that is the difference where we see ECI coming up on the LP as opposed to the GP leds, where we will cover withholding. So we'll cover ECI for withholding, but there's such detailed tax structuring done for these GP-led secondaries that it's actually not problematic the same way it is on the LP to LP.
Is it fair to say that, and just generally, if somebody is hiring, an external tax advisor as a buyer to go through what is the ECI on this fund, or they're requesting the GP to do that, and sometimes the GP will also hire external counterparties, those costs can add up. So would you say that sometimes it's worth groups looking into the ECI insurance as a provision and just excluding that whole kind of step in their DD?
So we have our internal team of tax qualified lawyers and underwriters, and they will assess the risk and put that policy in place, and it can be done pretty quickly. So it's just going to save all that time and cost of getting an external opinion from a third party and doing full detailed diligence into the actual workings and operations of that underlying asset in the fund.
I guess it's reasonable to expect that when you say, quickly, kind of a couple weeks to a month, like within that time frame, it can get done, right? If the deal is on the line for sort of ECI concerns.
Oh, way quicker. Definitely in a week. I think any secondaries can be done easily within a week.
Perfect. Time is of the essence in these things sometimes, for sure. So that's good. So of course you've mentioned, the GP side of the equation, and that it's very applicable on the continuation vehicles and fund wrap-ups and stuff. But you guys have also launched the LP to LP product. But could you walk me through why this is something that you think is going to continue to become more prominent and grow specifically in the LP market?
I think to date, there just hasn't really been focus on this area, and perhaps because there hasn't been a product. And there's kind of a recognition by us that we're doing amazing things in GP-leds, but actually, more than 50% of secondaries deal volume is these LP to LP trades. And you have your pension funds and family offices who may not be as familiar with the benefits of insurance as their GP sponsor counterparts, because they're using it in buyout deals. And then there is also that potential misconception that it is a large work stream and it's only suitable to bigger deals and there's more cost. So what we have done is taken all this on board and created a new product that is specifically tailored to these deals. And the reason we think it has fantastic potential to grow is it's not just providing that protection for the reps and warranties or the indemnity. We've actually created a solution where we think it can speed up the transaction significantly and actually make it easier to trade LP interests. And the way we've done that is through a synthetic policy and also through a portfolio policy. So the synthetic policy, essentially, the seller will not have to give any reps or warranties or indemnities to the purchaser. Instead, the purchaser will take a policy from us and we will provide that cover directly to them. So it's just cutting out, one, any obligations on the seller. So if that is your pension fund, there's no need to give these reps, warranties or indemnities or be concerned about what they are. It's done directly with us. And obviously the upside of that is it takes out all of the lengthy, protracted negotiations on the sale and purchase agreement. And that's both buyer and seller deal teams and counsel spending time doing that. The other thing that we're also doing is the portfolio policy. So a buyer can put in place an umbrella policy with us, and each subsequent acquisition, instead of renegotiating a policy in a PSA, we will actually just endorse additional cover onto that umbrella policy. So you've got the benefit of not having to renegotiate policies, renegotiate PSAs, but a buyer also then can get homogenous cover across their portfolio, because each time they're purchasing interest, they know that they're going to get the same rep cover and same indemnity cover because they're getting it through our policy as opposed to getting it from various sellers. And we can do this on a single asset, portfolio of LP interests, and also are happy to do the synthetic on even a mosaic transactions. But, we hope it's really attractive, and particularly where there's maybe sellers like pension funds, if they're starting to look at rebalancing portfolios, selling off older vintage interests, but are kind of slow with what reps and warranty cover they can give. If you just put that synthetic cover in place through us, it just takes out all that pain of negotiating.
Interesting. And I guess once, to your point, like once a buyer has done it once, they could probably recycle that policy to other deals with other sellers that they're working on, and just like small tweaks to the policy, but the policy is kind of that umbrella policy.
Exactly. That's it. Exactly. So it's a quick endorsement to reflect the details of each transaction, but you're not rehashing it or redoing it. And we do this on buyout deals, and it's just worked supremely well because buyer knows what they're getting. And particularly here, if you work in the synthetic aspect, they're going to know also what rep, warranty and indemnity cover they're getting in addition to what the policy looks like.
Could that be, I'm just thinking off the cuff here, but could that be an advantage to a buyer that, let's say, it's a competitive process with buyers bidding amongst each other, and they're so nil on price sometimes, right? And they're very close on pricing. So if a buyer's coming into a transaction, they're bidding on either a single fund or portfolio of, let's say, LP interest, and they have this umbrella cover already, and the seller knows, okay, negotiation with this buyer is going to be much more streamlined. They're not going to ask me for these obligations, right? So therefore, even the price delta may not be that big to the other buyer. I'm going to save legal costs and kind of time, and that's going to be advantageous to me. Is that,
100%.
Okay.
Yeah, nail on the head.
Cool. No, very cool.
That's what we're thinking. And the market's getting more competitive, discounts are smaller, and if you as a buyer can come forward with this, it could, and we hope will, differentiate your bid, because you're not just saying, don't worry about time and cost of negotiating.
Right.
We actually don't need any warranties from you at all. And allow that seller to not have to give those warranties, but also if it's a fund to fund, you can wrap up that fund earlier because you don't have those tail liabilities that you would have. Even if there was no indemnity escrow holdback, you still would have that tail liability on the books for the reps and warranties and obligations that you give. So it's that clean exit that you're offering them as well.
So to your point, some groups think, me getting into this insurance conversation, it's such a time suck for me, or I don't understand it or whatnot. But when should they be starting to think about whether it's applicable to their deal? Sort of at what point in time, when they've already, launched the deal and they've come up against issues in negotiation, or early on before they've even brought the deal to market? What is that time frame? Obviously, sometimes earlier is better, but is there a critical timeline at which point it just doesn't make sense anymore for them to look at it.
No, I don't think there's a critical timeline. I mean, obviously the earlier the better. And the beauty of these deals is that we don't need kind of lengthy diligence. So you can engage earlier. You know, it's not like a buyer where you have to wait till all the diligence is finalized that you can really underwrite it. So the earlier the better for sure. And as I say, sometimes we see GPs, you know, working this in super early stage, but whether you're an LP or a GP led secondaries, I mean, we can come in at any stages. We have in the past, I think, had about 48 hours notice, like deal is signing and now we need insurance. You know, we'll work to those timelines. But obviously, the earlier you engage, the better and the easier it is for everybody. But it's not a difficult process. Like, we fully appreciate how busy everybody is and how much work goes into these deals. So insurance, we try to make it as streamlined and easy as possible. And even, you know, for a seller or a buyer that's the first time using that, we've been through this so many times now with people that are doing it for the first time, and we aim to make it a really easy process.
That's awesome. And that actually is a perfect segue into what I was going to ask in terms of, you know, how do you go about underwriting this types of deal? And not that I want you to reveal any trade secrets or anything, but, you know, from a group that's considering integrating it, they might wonder just how cumbersome it is. What do you need in order to underwrite it? Where's the doc provisions, etc.? Maybe just a quick comment on that.
So I think the beauty of secondaries is that it's very streamlined compared to a buyout deal, because you're not going in or covering any operational level reps of the underlying target assets. So it cuts out a lot of the work and a lot of the DD. So we will typically rely on what's available and what's being done for the deal. So in a GP-led, we would look at the fairness opinion or the third-party valuation of the assets. Obviously, that's quite important in terms of value and conflicts. And we'd also look at the tax steps plan or the tax structuring memo. Other than that, there's no specific DD that we'll look for or need to take time to review. We'll take a look at the data room. Anything else that is available, of course, we'll take a look at it. We'll look at the fund documents and the new underlying LPA for the new fund. And we will ask the GP about the election process that they're going to run with their existing investors. Aside from that, we'll ask kind of a couple of high-level questions about the GP's management of the underlying asset. Obviously, motivations are quite important as well. And that's all done through a Q&A. In the US, it's a call. And in Europe and Asia, it's people prefer to do it in writing. So it's really at the election of the buyers, what they want to do. And so that's with the GP. And then we will have a very quick call with the lead investor. Also in the US, it's about a 10-15 minute call. And in Europe or Asia, it's a one-page Q&A. And again, it's just to understand their motivations, if they had any kind of prior relationships with the GP, and what their kind of evaluation of the underlying portfolio is.
And actually, that's interesting that you mentioned, you know, US versus Europe. Are there any other notable differences like that when you're implementing RWI policies between US versus European counterparties?
There is. So the bulk of what we do is still in the US. I think insurance is just generally used more in the US, and it's a very established market. There's a few key law firms that you'll see across every deal. There seems to be a pretty uniform approach in terms of the representations and warranties that are given. And they tend to be, you know, centered more around the fund level exposures. And that's what we call true secondaries. And so that just makes it super, super streamlined. So Europe, it is a little bit more fragmented. So there's obviously various jurisdictional considerations. There's a wider variety of advisors and players in the space, and you don't really see that uniform set of warranties or approach that you would see in the US. And in certain European jurisdictions, we've seen it now in France and Spain in particular, they're almost taking a more buyout approach to GP-led secondaries in certain deals. And that kind of, there's coverage then for more portfolio level warranties, and then there's more diligence that needs to support those warranties. And so the process kind of turns more towards the typical buyout process that you would have on a traditional buyout deal. So there's a little bit more work involved, and it's probably not as streamlined.
I think, look, it's only a function of time and adaptability, right? As groups continue to use the secondary market, it's just going to get more streamlined. So I assume that Europe will probably very, very quickly catch on to the same streamlined process as the US. And then I guess the last question in terms of my digging your brain for this specific subject. Is there an asset class that's most applicable?
Yeah, so I don't think there is a particular asset class that it's more suitable to. Definitely what we see is buyout. So the majority of the GP leds that we'll do are buyout. That said, we are seeing more interest in for real estate GP-led secondaries and infra deals. Our fund wind down product. So we also do a product that comes into place when a fund has disposed of all assets and wants to wind up. For some reason, we've seen more of those in the infra space, but I don't know, is it just a matter of time that we'll start seeing more of those risks? But for sure, the policy is adaptable and suitable for all of them. And there's no reason why it will be any different for one over the other. And then in terms of single asset or multi-asset, again, we will do all of them. I think we probably see more single asset deals. So you see that kind of trophy asset coming through. But equally, we've insured many multi-asset deals. And if it is that true secondaries, it actually isn't going to materially impact on how we underwrite it or even the pricing. Because again, we're not covering the reps and warranties at that target level. So it doesn't really change how we do the deal, and it won't make it dramatically more difficult to underwrite.
Thank you, Sarah, for sharing your incredible knowledge and experience with our audience so far, and demystifying what can be viewed as a black box to some. This part of our chat I really call the bragging rights corner, where I would love to learn about perhaps some incredible performance and deal tidbits that you'd love to highlight about CFC's accomplishments, and what has been your biggest success in RWI and secondaries to date.
Yeah, so I think it's just growing the US secondaries market and taking it from, virtually nil or no deals being insured back in 2019 to now what we conservatively estimate to be 35% of all GP leds being insured.
Wow, that's a big number. That's a really big number in a short time frame.
Yeah.
It's exciting. And then now you're on to the LP area of the world, right? So growing that. And how has technology helped your team achieve success and streamline the business?
Sure. So because CFC is not just a transaction liability insurer, started from cyber roots. So there is a big emphasis on technology and constantly improving. And we actually have specific technology and innovation teams. And so we recently created a new product, and we're the first market to embed an insurance offering into an online platform. So we worked with flippa.com, and you can essentially opt in on that online marketplace and place a policy. So it's almost back to our click for cover days. And it's our hope that we can do this as well with the LP product. So I think getting that first embedded offering out has been a huge achievement for us.
It's going to be exciting to see the progress. So now, just before we let you get on with all the fascinating transaction and underwriting activity, I'd love to ask you a few rapid fire questions to wrap this up. Are you ready?
Sure.
All right. What's your biggest pet peeve in your work?
I shouldn't say it, but leaving it till the last minute. So I think we've discussed the early engagement is fantastic. We can do it in very short timelines if we need to, but for sure, early engagement is great. So,
well, I have to ask, what is your least favorite part of your job?
I think it's those late nights you referred to. So 5 a.m. finishes. As nice as it is to hear the birds singing, it's not great, but that is just M&A. So.
Yeah, I think, I always say Q4 is like the craziest quarter in the year where everybody tries to wrap everything up. And I don't envy the lawyers for sure when it comes to kind of end of quarter, any quarter, but especially Q4. And I would imagine the busier that you guys get and the more common this practice becomes with RWI, the more you're going to be disliking end of Q4. Yeah. And I guess any suggestions to new entrants to secondaries as a whole that you would give as why it's a good industry to explore in general?
Yeah, sure. So, I can only speak from an insurance perspective in terms of secondaries, but for me, it's just been a fantastic area. I think it's so relatively new that you can get super involved with the product creation and, big deals from a very early stage. And I would just, in terms of advice, I think just reach out and speak to everybody you can. There's a really great network of women in secondaries, actually, particularly in London. There's a lot of female advisors leading secondaries practices and advising the players in the space. So just, reach out and talk to everybody. And there's just loads of opportunities to network and grow, which is really great.
Yeah, I couldn't agree more. There's a lot of camaraderie in the industry as a whole, whether it's across advisors or other insurance providers, lawyers, I always find that I can at least call somebody and they would be absolutely willing to help, which I haven't seen in a lot of other industries in finance. So that's exciting.
Totally agreed.
And lastly, why is CFC best positioned to lead the charge in secondary market RWI?
Yeah, I think, look, we were the first to do it in the US for the GP-led. I think given the background of the company and the way we run, it's just continued innovation and trying to think, what can we do better? And, that's resulted in the creation of this new LP to LP synthetic policy and the ECI tax policies. They're both totally new to market. So I think it's just knowing the market, using all that experience that we've built up and trying to stay ahead with new products and new offerings.
Well, Sarah, thank you so much for speaking with me today on this really fascinating topic of reps and warranties insurance, which, we will see becoming a big part of both GP and LP focused transactions. And I'm sure there will be many who will dig up this podcast, dust it off, find it somewhere in our records, and, listen to all the incredible use cases and details you have shared with me today. And so I can't wait to see the types of creative solutions you and sort of CFC put forward to the ever-growing secondary market. I think it'll really assist with sort of driving standardization, ease, streamlining of processes, more transaction volume, etc. And so I'm really excited for that. And thank you for sharing your knowledge and for joining us today.
Super. Thank you so much for having me. It's been great to chat.
Once again, everyone, this has been Sarah Cardiff, Senior Underwriter at CFC, and thank you for joining us today. As always, watch the SecondaryLink LinkedIn page for updates on our next special guest, and we hope to see you in a few weeks where we highlight the next incredible woman on the Women of Secondaries.